welcome to tradingfloor.com's weekly Asian focus. In this video with Andrew Robinson, market analyst for Saxo Capital Markets in Singapore, he comments on key upcoming data from China, which is expected to give further indication that the all-important Chinese economy remains vulnerable to the growth issues plaguing most parts of the world. Welcome, Andrew.
Hello again.
China will release trade data for September at the end of the week, which is expected to show limited expansion in exports. What are the key factors keeping the trade balance in surplus in these difficult times?
Well, I think it's basically slower imports, basically. We've seen import growth slowing throughout this year. We're currently at the lowest we've seen for the whole year, dipped into negative territory in August. So I think basically that's the side of the equation which is keeping the trade balance in a positive territory. Certainly, as you said, the export side is really struggling. The markets are almost drying up, so that growth is not doing very well at all. But it's the import side which is slowing down dramatically, and that, of course, has a knock-on effect into the rest of the Asian economies.
Are the main issues trade-wise for China the slowdown in Europe and, of course, reduced consumption in the US? And which of these weighs most heavily on the Chinese economy?
Well, actually, if we look at the total exports to the Eurozone, they're just below the $30 billion mark, and yet those to the US are only just above the $30 billion mark. So they're quite evenly matched, I think. Obviously, there's every chance that the Eurozone slowdown is going to be a lot more protracted than the US slowdown. So I think that is obviously going to be the bigger weight on the China export story.
The International Monetary Fund, in its global forecast this week, said that China's growth will slow to 7.8% this year, and it won't return to double digits anytime soon. Chinese authorities, however, they expect an even grimmer rate of 7.5% for 2012. But at the same time, they see a 10% increase in trade. Is this at all realistic, considering the difficult external playing field?
Well, if you look at China's total trade volumes, in 2010 they were rising at over 20% a year. 2011 it slowed down to just above 12% a year, and when we come to this year so far, we're down 1% on the year. So if to achieve anything close to their 10% target, then we're going to have to see a dramatic turnaround in Q4, and quite frankly, that's not going to happen. So yes, it is a bit of a pipe dream, I think.
What about the measures introduced by the Chinese authorities to lighten the load from this slowdown in the global economy? I'm thinking of infrastructure projects, reserve requirement ratio changes, interest rate cuts, and of late, even the suspension of customs fees on incoming and outgoing goods. If not now, then when are such actions seen providing some kind of relief?
I think all the measures that you mentioned do have a certain time lag associated with them before they do start to have an effect. Infrastructure projects are long-term by definition, and the time it takes for the adjustments in the interest rate spectrum to filter through into the economy, we're talking anything up to 6 months time lag. I think the most instant impact we will see is, as you said, from the cutting out of customs duties and what have you. So I think eventually there's no doubt it will filter through, but in the meantime we have to be patient, and we've probably got to survive some pretty seriously bad data in the meantime.
Considering this difficult backdrop, are we likely to see any re-evaluation of the yuan in the near future?
Well, the yuan has been surprisingly strong throughout the last 3 months. Since August, we've moved quite dramatically, and this was in line with the dollar's fall prior to the quantitative easing measures that the Fed announced. Since QE measures came out, then the dollar index has actually moved higher, but the dollar-yuan rate has stayed where it is at the bottom of the recent range. So I think there's not been much mention about the exchange rate, to be honest, from both the Chinese authorities and the US authorities. So I think it's taken a bit of a back seat at the moment. I mean, the biggest issue, I think, is that even if you want to devalue your currency to make your exports more attractive, if nobody's buying them, then there's no point. There's still no market for you to export to.
Inflation data will be released at the end of, at the start of next week, and a softening in price pressure is seen for September. Though with agriculture commodity prices increasing, how much of a concern are perhaps rising food prices for China?
Yes, as you say, we're expecting CPI to come down slightly from the 2% last month to 1.9%. That puts it just a margin above the low we saw in July of 1.7%. The biggest issue for China's food inflation is the meat sector. Pork prices across 50 cities in China, the latest statistics show that they've been rising at the rate of 0.8% per 10-day period. When we look at beef, that's even more astronomical. That's up something like 1.5% on average. So it's the meat portion of the food basket which is creating the inflationary pressures in the food inflation. Biggest problem is when it's food inflation, any adjustments to interest rates or whatever simply have no effect. You can't fight food inflation with interest rate moves. So I think it's something that you've simply got to grin and bear and maybe stop eating. That's the other solution, I suppose. But generally, food inflation is something they have to worry about. But the rest of the inflation basket is behaving relatively okay. So I think near term, we're going to hover around this 2% level.
Thanks for your insights this week on the situation in China, Andrew.
You're welcome.
Take a look at tradingfloor.com for more of what Andrew is writing about the Asian region.